Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1014A, and today's date is July 5th, 2016, and the title of the episode is The Economic Collapse Dominoes Are Beginning to Fall. Let's get into the economic collapse financial news. What a day on the market today. We see the market is down by 100 points or so. Gold has shot up around $19. Silver is hitting the $20 mark, and we are seeing the central bankers, they're losing control of the system. And we see that out in the UK, they had the Brexit. And I understand that this is a very good thing, where the people are saying, listen, we don't want to be part of the central banking establishment, and we need to get away from the EU. But to me, it looks like all of this was done and orchestrated, because you have to remember, they really didn't vote the UK away. This is a advisory referendum. They have not enacted Article 50. They have not voted on this. The EU and the EU states have not voted on this. So nothing really has been done right now. But we do see central banks, governments, corporations, banks using this as an excuse to do things they normally wouldn't do, like giving Italy's banks bailouts when all the banks in the European nations signed bail-ins. Now, neither are good, but they allowed the Italian banks to do this. We see that the banks are going to be, the central banks are going to be creating currency out of thin air. They're using the excuse of the Brexit. We do see other things occurring at this time, and I believe this was to reduce the bubble, let some air out of it, buy them some time, because the economy was deteriorating too quickly. And they allowed this to happen. The central bankers are always scheming and planning. They're always ready to make their move in whatever they're doing. And right now, they think in their minds that they have control over the people. And what they're doing is they're controlling and orchestrating the situation, and they are trying to keep their system alive a little bit longer because they don't want to be blamed for what is about to happen here. And this is why they're provoking other nations around the world. Now, we've been looking at the economic information. We're looking at different sectors, and we have noticed that each sector is contracting right now. GDP, manufacturing, we've been noticing retail, housing. Even though the government, yes, they're telling us that everything is improving. The central bank is telling us that everything is fine. Maybe it's a little bit slower than we wanted, but unemployment is strong. But we know these are all lies. So we look at rail traffic once again. And for the first time since 2009 recession, year-to-date values are down versus the prior year. The last time this happened was in 2007, which shows that there is a significant economic weakness ahead. Since many of these items that we're talking about are imported, this is a red flag, not only in the U.S. economy, but also in countries that rely heavily on exports to the U.S. Given that this has been going on for some time, economists should not put the blame on this contagion of these recent events on the Brexit, which they're about to do. Now, housing, that is another important sector of the U.S. economy. The forest products category includes lumber, a key input of the housing construction. Now, they've been telling us that new construction is doing very well. Houses are selling. They're trying to convince us that everything is fine. But then why are volumes weak all year, reaching levels below the minimums on several occasions? This is very odd, since the U.S. Census Bureau data shows that new privately owned housing starts and under construction units were up in May compared to last year. Something, again, does not make sense. Lower volumes suggest a more muted positive impact on the U.S. economy from the more bullish housing indicators elsewhere. And we see right now that the decline in volumes is usually a warning sign that there's further trouble ahead. And this is exactly what we're going to see, further trouble. Now, people are going to say, well, what about automobiles? Everyone's saying that sales are up. You have to remember how automobiles, how their sales are taken. Manufacturers can produce autos, they can channel stuff the lots, and when they deliver the cars to the lots, that's counted as sales. It's not when the person purchases a car. So that's a different animal right now. Plus, you don't need any money to purchase a car. All you have to do is walk in, you have a heartbeat, they'll give you a loan. And you can drive off with a car. This is what they've been doing. They've been tapping the subprime market. Now we see factory orders, new orders have fallen in May on weak demand, and we're starting to see that manufacturing, even though the corporate media, the U.S. government is telling us, oh, we're seeing a rebound right now. No, we're not. This might be a little blip, but the overall trend is still down. And we've seen these little dead cat bounces here and there. And what happens right afterwards? They fall right back to where they were, or worse. And this is exactly what we're seeing. The Commerce Department said on Tuesday new orders for manufacturing goods declined by 1% after 2 straight months of increases. And we're seeing it right here. So they thought there was going to be an increase in manufacturing, and their expectations were completely off. Now, out in the UK, we understand that the corporate media, the governments, the central banks, they're all going crazy over the Brexit. And we're already seeing signs that the central banks are using the Brexit to do things that they would have a tough time explaining. The Bank of England lowered capital requirements for UK banks in an effort to shore up the UK economy, saying that it strongly expects banks to support the economy with fresh loans in the wake of the Brexit. So, what we're seeing right now, in its first official easing act, the Financial Policy Committee lowered the counter-cyclical capital buffer rate for UK exposures to 0 from 0.5%. So, what we're seeing is they're doing all of these things, blaming it on the Brexit. Now, we've seen other things occur in the UK. Standard Life investment property dropped by 15%. They've been forced to stop retail investors selling out of one of the UK's largest property funds for at least 28 days after rapid cash outflows. Why? Because of fears of falling real estate values. We see UK's Aviva property fund. It is frozen due to lack of immediate liquidity. And we see right now, if we look back at the events that brought down Bear Stearns in 2008, we see that Standard Life, they forced to stop retail investors selling out of one of the UK's largest property funds for 28 days. Now we see Aviva, they are freezing it. M&G suspends trading of their property portfolio fund. And this right now are signs that the central banks, they're covering up the real problems here. And this has nothing to do with the Brexit. They're using this time period to shore up the banks, to bail out banks, to create currency. And when we look at this situation, it seems like this is what the Brexit really was. Because again, I have to say it, still nothing has happened yet. The UK is still part of the European Union. But look what the central banks are doing. Look at the excuse they're using to do all of this. Now, Italian banks, they are completely falling apart. They are a time bomb. And we can see right now that these banks, they have a huge percentage of non-performing loans. And we see right now that they have so much bad debt that these banks, they might be the first to go here. And when we look at this, we see 17% of the bank's loans, they're sour. This is nearly 10 times the level in the U.S., where even at the worst of 2008-2009 financial crisis, it was only at 5% back then. One of the major banks, Banca Monte dei Paschi, bad loans were so thick, it assigned a team of 700 to deal with them and created a new unit to house them. So we're seeing that Italian banks now exceed 360 billion euros, quadruple the 2008 level, and they continue to rise. The situation is getting worse as time goes on, but it did allow the EU, the central banking system, it did allow Italy to receive bailouts because they didn't want to use bail-ins. Now, both are a problem because it always goes back to the taxpayers. Bail-ins, it goes directly to their deposits. Bailouts, you pay in other ways through taxes. So no matter what, the central banking system, it is completely designed where the people will always be paying, no matter what happens. The only reason they came up with the bail-in documents is because government said, no more, we cannot have these bailouts. So they said, no problem, we're not going to go to the governments anymore. We'll just go directly to the people's accounts and take their funds from their accounts. It's that simple. We don't have to worry about this. We don't have to get approval. Think about what they've done here. They don't have to go through any type of Congress or Parliament to get approval for bailouts. All they have to do is go into the bank and take your funds and say, here's a worthless piece of stock paper, and we'll replace it with the currency that you have in your account. And this is their plan, to keep their system alive. And again, the people will pay. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.